From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 29th, 2020, and this is the Macrocast. I'm Tony Fratto in New York City. John Fagan and Brendan Walsh from Markets Policy Partners are in Washington, D.C., and we have a lot to talk about today, including what the stock market's been doing. We've got reopening of the economy and the staggered way that's rolling out and the implications and consequences of it. EU programs that are innovative and hopefully will have an impact in Europe. May even get into some Twitter wars, the current Twitter wars, which are just ongoing as we sit here live on Twitter as we speak. But first, we have to talk about China. Back to Chinese tensions throughout this administration. It's been a roller coaster ride. We've had tariffs, and we've had a trade deal, and we've had accusations over how China has dealt with coronavirus. We've had tension over Hong Kong that has risen and fallen, and simmering. And now it looks like China is taking advantage of where things are in the United States, especially, and they've always had, high interest, and this is a long part of their program with Hong Kong. But the situation in the United States, where it's hard to keep our eye on the ball of other things right now with coronavirus, with the U.S. elections, the sort of confluence of events in the United States, but we are seeing action on it. The administration is paying attention to it. Congress and the White House are paying attention to it. Big Chinese tension, I think, is going to be part of this campaign season, as we've talked about before. But where is this leading now, and what do we think the economic implications are going to be, John?
Yeah, thanks, Tony. Where this is headed today, on a very short-term basis, is a White House press conference on the response to the situation in Hong Kong. This is a press conference that was announced yesterday toward the end of the trading day in the U.S. and when that crossed the headlines, the markets slipped from highs of over 1% on the S&P 500 into slightly negative territory, showing the extent to which investors are focused on this. President Trump had pledged earlier in the week that he was going to announce the White House's response to the Chinese clampdown on Hong Kong this week, and traders had bandied about what might be on the table. We got some additional clarity on what might be coming on Wednesday, when Secretary of State Pompeo declined to certify that Hong Kong was meaningfully autonomous from China. The import of that was it triggers potential retaliation from the U.S. under the Hong Kong Human Rights and Democracy Act, which was signed into law last year, sort of begrudgingly by President Trump, who actually, when he was signing it at the time, sort of as an aside, sort of mentioned that this might, this might be a complicating factor down the road. President Trump has not made, very specific statements on what his preferred retaliatory response is. We've certainly heard the hawks in the administration, Secretary of State Pompeo being chief among them, sort of leading the charge here. But President Trump has sort of kept his own counsel on this. There are reports that so just to roll the tape back, the Hong Kong Human Rights and Democracy Act, if the State Department doesn't certify Hong Kong as autonomous from China, then that gives the executive the power to review Hong Kong's special trading status, and that the preferential trading status that Hong Kong enjoys relative to mainland China. And so again, that is discretion of the executive. And the question today is the extent to which President Trump is going to exercise that discretion to do a sweeping withdrawal of that kind of preferential treatment for Hong Kong, or a rather relatively more targeted one. Reports are indicating that it might be more relatively more targeted, with focusing on specific U.S. exports from Hong Kong, pulling away some of their preferential tariff treatments, and including some, along as kind of a sidecar to that, withdrawing or reviewing some of the visas for Chinese students and researchers that have specifically military ties with the Chinese military. This is an example of what we've seen is, the Trump administration obviously taking a hard line on China, and as you said, Tony, turning this into a campaign issue for the fall, but at the same time trying to dance along that fine line between tough on China and drawing a meaningful retaliatory response from Beijing. Blowback from Beijing could be very serious and self-defeating for the president in his re-election campaign. He's banking on an economic recovery, and meaningful Chinese retaliation could certainly.
And there's just also lots of complexity there too. I mean, that's one of them, right? But also, if you're going to do things to Hong Kong, even in a limited way, remember we're trying to support Hong Kong, right? The whole concern here is that mainland China is mistreating Hong Kong. So if you take these actions that could diminish the asset of Hong Kong, you're actually hurting the Hong Kong people. And so this just makes it very complicated. Now, if you've determined that they're not autonomous anymore, then you are conceding that Hong Kong is fully part of China, which the Chinese, of course, say yes, it is, and it always has been. But there's this contract with the UK and the international community that says not for a couple more decades is it fully part of mainland China. So there's a lot of complexity there on how you deal with it. The other the other piece of it is, though, we talked about there's the economics of it. There's a commercial relationship with Chinese firms that are operating in China. A lot of Western firms that use Hong Kong as a hub. You can hurt them, and to your point, John, if you damage their ability to do business in Asia that way, then they're not as successful, and foreign non-American firms will be able and will have that advantage and capture market share and all those kinds of things. So there's that. There's also just the fact that if you're doing it for political reasons, the politics on this are really tough. I mean, you can never do enough to satisfy China hawks, right? And if you're in an election with Joe Biden and it's a race to see who's the toughest on China, you're not in an advantageous situation, because the other person can always say you went limp, you didn't do enough, you took it easy on him, and you have all these love notes between Trump and Xi to
right.
to back up your assertion.
Well, that's certainly an issue, and and obviously the Biden campaign is going to try to do that, outflank President Trump. But what we've seen from the Democrats repeatedly on the China trade issue is not so much that they push back against the overall direction of the policy countering China on certain issues or being tough on China. It's they quibble with the methodology. You're doing it the wrong way. And that's what we heard Joe Biden say earlier this week in his interviews. He's talking about, when he talks about what he would do differently, it's marshaling an international response. And that's just not the way that the Trump administration is going to work. No. But certainly, what we're seeing today is just one front in a multi-front campaign. We talked last week about that bill that passed the Senate that has more targeted sanctions against individuals and entities, Chinese individuals and entities that participate in the suppression of Hong Kong. So that would, maybe ameliorate some of the concerns about punishing Hong Kong for being cracked down upon, in effect. But we're also seeing the bill that passed the House this week on sanctions for entities involved in the suppression of Muslim minorities in Western China. That's going to the president's desk. He hasn't said specifically whether he would sign it, but reports are indicating he will. And so much of this is, the reality is the difference is, signing a bill and then enforcing it. And we're seeing this today with the Hong Kong Act. I mean, he has power to go, to an extent against Hong Kong that would probably draw us a significant reaction and have a major market impact. But we're guessing that he's probably going to try to come short of that and make a statement without without getting a blowback from markets and on the economic sphere.
Tony, how much do you think?
Go ahead, John, or go ahead, Brendan.
How much do you think that a bipartisan Congress who can pass bills every day if they want to, and kind of force Trump into being more hawkish than he may want to, is that a big risk going forward?
It is. Like, if you've seen the votes on the China bills, every China bill that comes is, I don't know, it's 95% bipartisan, some cases 100% bipartisan. You cannot. This has always been the risk of allowing the legislature, allowing Congress to drive China policy, because China is unpopular for some very legitimate reasons, for some misunderstood and illegitimate reasons too, but for some very legitimate reasons, China is unpopular. And politically, the place to be is anti-China, to be attacking China. That there is no American constituency for defending China at all. It doesn't exist, except for firms that need to do business in China.
Yeah,
and they're not even, they have concerns about China too, but you cannot be a globally active firm and be profitable and successful if you do not have operations in China. It's the biggest or the second biggest economy in the world, and of the three major economies, it's China, Europe, and the United States. You can't ignore China and be a globally successful and profitable firm. So that makes it really hard. But there's no popular constituency for China. So anything you put out there, delisting, sanctions, Hong Kong protection, you name it, if it's going to be anti-China, it's going to get near unanimous. And so you look to the White House administration for, sort of clear-eyed leadership on some of this stuff. But you have, the president, which has been, pretty anti-China. You have, Pompeo, who's a strong China hawk. You have the guys at the National Security Council are China hawks. You have Peter Navarro, who's a China hawk. It is an administration of China hawks over there. The president, I think you're right, that he's probably going to step back from doing big dramatic things that would cause big economic breaches. I think it's in this, that's part of the political calculus here that makes it really tough to do something to China and not shoot yourself in the foot. But I do think that with increasing bills and increasing popular activity, and if we're looking at Hong Kong protests, and if the Chinese do hard crackdowns on Hong Kong protesters, and it starts looking ugly again, then it makes it very, very difficult for him, and Congress is going to still be there to keep that pressure on.
And how much do you think the president's decision making on China and how hawkish or back away is based on trying to keep the stock market up?
But I was going to ask you guys about the market. I mean, we know he uses the market as a measuring stick. Whenever it's up, you can expect a tweet from him saying it's up. He doesn't seem to tweet when it's down, but he does tweet whenever it's up. Somebody showed the third Trump tweet the other day. I saw somebody showing the third Trump tweet celebrating the Dow crossing 25,000. It's crossed 25,000 on the upside 3 times in his administration. He has celebrated it on the upside 3 times. He's never noted it on the downside. But so we know he uses it as a measuring stick. But I was going to ask you guys, when we were going through the negotiations on the trade war and the phase 1 trade deal, you can see on any given day, if you were either, it was either a China positive day or a China negative day. It was a China positive day, market was up. China negative day, market was down. You could see just very high sensitivity to news on China. And John, you started, when we talk about China, said kind of brought the market to a screeching halt yesterday when there was news of this press conference on China, and it did. It sold off and gave back gains, and and was down. The futures are down, I don't know, 130 right now. Doesn't seem like anyone's expecting. I think like the sort of our view that it will be loud but not impactful seems to be the market consensus right now. And do we think that the market has broken that link a little bit?
I think this is the first week it came on the radar that China is back to being a risk, especially now. I mean, we're not back to all-time highs, but we're basically where we are at the start of the year. And for much of the reason that the market came back based on the tech sector, a lot of innovation, the payments were going to accelerate. Zoom was a stock we didn't even know existed. Now it's, the biggest stock in the world. But the last week or two, as the economy reopened and we have optimism on vaccines maybe by the end of this year, the rest of the growth economy has started to pick up, banks and whatnot. So that's been what's driving the market. If we have a situation where we get in a deeper tit for tat war with China that affects that recovery, that's not good for the market. So we're in this point where it's not that the market has to crash 50%, but we've priced in a lot of very good things.
Yeah.
We're reopening the economy. In the next 2 weeks, we're going to get a lot of data to see whether that was a good idea and whether infection rates are going to go up in places like Texas and Georgia and Florida. So that's a risk to the market. And then China's a new risk to the market. So I think these next 2 weeks are really, really important for which way the market goes down, whether
so you're looking for
10% or up or 10% down.
I do. Your point on things have been the grinding halt to the economy was so bad that we say, well, everything was shut down. It's like, your point was great. It's like actually not everything, and there were some that were clear winners out there, and the Amazon, Walmart, Target stories have been pretty well told. Zoom is a good, well told story. There are a lot of others out there. I mean, Williams Sonoma reported today and beat expectations pretty well, and every one of their stores was shut down. Every single Williams Sonoma store was shut down, and they just crushed it on internet sales. And so there actually are winners and losers here. And not just winners. I don't know what Sur La Table did. Did they do as well as Williams Sonoma? And this is like one of those things that shake out in a recession, right? Yeah. Like the better companies do better. Well, I don't know. Like again, maybe Sur La Table is doing really well too. But you know what I mean? Like you get winners and losers. Yeah. Then you have the inflation, the lift from the Fed.
Yep. $3 trillion.
Which right? Trillions of dollars.
So the stock market rebounded about $3 trillion from the low to the high, which is basically what the Fed injected. So I know a lot of economists say that QE doesn't drive stock prices up, but the two charts kind of correlate pretty well.
They seem to rhyme with each other.
What economists take on quantitative easing is a whole lot different than Wall Street's take. If you ask Wall Street, what does quantitative easing do? It's rocket fuel for stocks and for risk asset prices. That's what it says on the box. That's what Ben Bernanke said. That's what Chairman Bernanke said on his way out. They said, how did QE work? He said it didn't work except through the asset inflation channel, which was the portfolio, basically the wealth effect. It made Americans feel richer to the extent that they're invested in the stock market. It made them feel better about stuff, and that's how QE works. It lifts asset prices. And he said all the other stuff, was kind of marginal compared to that. Yeah. He may not. That doesn't mean he's right, but that's what he said.
But we also do QE when rates are hugely low. So you get to that point where there's just nothing else to buy if you have to have some sort of return. So I think that plays a role in it too.
Well, there is something between there is something about the stock market and the economy, and let's come back and talk about that. I'm going to talk about that and how we think they're looking at reopening. You're listening to the HPS Macrocast.
Markets Policy Partners provide sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
All right, back. Brendan, what's this link between the market and the economy?
So for the election, I feel like the stock market could play a completely different role than it usually does. While we always say the stock market isn't the main street, the economy, the two are usually fairly in lockstep. But we know that this recovery is going to take a while. It was unprecedented. We had to shut down the whole world, and it's going to take a while. And also, the virus is still out there, so things are going to be uncertain. So usually when the stock market's high, unemployment's relatively low or going down, and people feel better about themselves. That's not necessarily the case right now. So if Trump is going to run on the stock market, really the only people that are benefiting from the stock market right now are wealthy people that are invested in it, where we still have 25% unemployment. So I don't know the answer, but the stock market could become a negative for Trump, where he's just viewed as protecting the rich while the rest of middle America is still on their back.
Well, on that point, Brendan, we were looking at sort of like household balance sheets on some of this stuff, just trying to figure out like where we are with reopening. We have a bunch of states who are moving from, they're using these color codes of, like yellow to red, red to green, and some are moving from yellow to green. So they're starting to increase economic activity. And there's that, my good friend, Josh Holmes has an op-ed in the Wall Street Journal today talking about, what will happen politically when the money runs out. Now, I don't think the money's going to run out, but there's also, a phenomenon that we've actually never ever seen before in a recession, where we actually have balance sheets for a whole lot of people. I don't want to say everybody, because there's some people in pretty bad shape, and some businesses and small business owners who are in pretty bad shape, big business owners too. But for a very large portion of the economy, their balance sheets are in pretty good shape. And Brian Moynihan was on CNBC yesterday talking about what they see in their customer accounts with people who generally have less than $5,000 of savings in their accounts. Those balances are 30 to 40% higher today than they were in March, which is amazing. You've never seen anything like that before in a recession. Usually you have, income impaired, savings impaired, costs going up. But because people have not been able to buy anything, even in the cases where so many of them lost income, unemployment insurance was there with a $600 a week bonus. If you were concerned about your ability to pay your rent, you've had rent forbearance. If you're concerned about your ability to pay your mortgage, you've had mortgage forbearance. So coming out of this period, and reemerging into a reopening economy, in however way that happens, there are going to be like demand will be hurt by people's concern over being around other people. Yep. Demand will be, or I guess it's really a supply thing, like the space for people to come in and access things like restaurants and shops is going to be, they're going to have rules to follow, limiting, choking the number of people that can actually go do things. Still not going to be able to do really big events with lots of people, but people are going to have money to spend on things. And if they have it, this is America still, they're probably going to go out and spend it.
Yeah. I mean, so we got the personal income and spending. So spending was down 14% and income was up 10.5%. It's a very simple story. You weren't allowed to go outside, so you didn't spend that much. And government transfers went up 90%. So that's the story. So I think you're right that when we open, you saw it in China too. People rushed to, Prada to buy things, and they were excited. The question is just how long it takes for people to feel safe to get to that point.
I think it's absolutely right that people are excited to get out, and certainly, from the virologist perspective, they're trying to tamp down people's enthusiasm and interest in getting back to human contact a little bit, and just trying to reinforce the fact that they've still got to keep safe and that sort of stuff. But human nature is human nature. I mean, just casting an eye forward, thinking about, where we are right now, it's hard to think of a time, it's certainly maybe 2008, 2009 qualifies, where it's more uncertain looking into the future. Mm-hmm. Obviously, cast your mind ahead to December 2020, not too long from now. And we could have all gotten our, a Band-Aid on the arm with our vaccine jab, out at the restaurants and bars, and looking forward to a great holiday shopping season with a rebounding economy, and, insert your favorite presidential candidate, just won re-election or election, or, whichever you prefer, you could have a very bright, sunny outlook on life. And the flip side of the coin is also certainly perhaps equally possible that we would be, December 2020, we're hunkered down under a second wave of lockdowns with the pandemic back. We're in trading broadsides of sanctions and tariffs with China. The U.S. economy is stumbling along recessionary or worse kind of pace, and for individuals, insert your least favorite presidential candidate. Won, a contested election. There's a really dark, the tails have gotten so fat, and the dispersion between these two very possible scenarios is so wide, and we just see, the stock market appears convinced of the rosy one, and the treasury market appears convinced of the darker one, and it's a real split decision. And this is a caveats included, that there is a lot of price distortion based on central bank intervention in markets, but we still think that there's signal in these very divergent price actions. And basically, both the treasury market and the equity market, they both probably can't be right.
Yeah, but Tony, I think we should go back to your point that a big reason why we're at the point where we are today is because the monstrous fiscal response. Yep. We had a decent response in 08 and 09, but nothing compared to this. But the battle's not over. We still need more fiscal response to get us from here, tomorrow's June 1st to November, where maybe we could be at a vaccine point. So yesterday, the New Jersey governor said that they're going to have to lay off half of the workforce, 200,000 people. They have a $10.1 billion hole. So in 3 months, they had a $10 billion hole. You extrapolate that forward, they're, in 3 months from now, they'll have a $15 to $20 billion hole. So, Jersey is a pretty decent sized state. But, if Jersey has a $10 billion hole, California probably has a 25 and Florida has a 10. So you're talking about, probably $1 trillion hole in state and local governments that needs to be filled if you don't want to have another massive wave of layoffs.
Yeah,
and
to me,
go ahead.
No, go ahead, Brendan.
No, I'm just saying, on the Hill, it seems like they're coming to that realization, but it's not today. It's a month from now.
Yeah, I think that's right. I think to me, those are the big unknowns, right? It's like, does that, just how damaged are state and municipalities? We know it's big. I think Michigan reported, that they're going to have to do some massive layoffs as well, and then there's this. To me, the great unknown, which John talked about, is the potential for a second wave. And sort of every epidemiologist out there you talk about essentially says it's like there will be a second wave. Like don't think it's not coming. And the only question is how severe it will be
and how prepared we are for it.
And when exactly the timing is. And I will tell you, if we've got consumers who we've just said they're going to have money to spend, there's going to be this euphoria over reopening a bit and getting back to something like normal. Some sports are going to come back in some ways, and and the question is does the summer look like a false dawn?
Yes.
And then we have a return, and I think I think Americans, we've seen some of the protests, and we know there have been some anger over the closing, and is it too much? And did we all do this because of New York? And there's a little bit of resentment out there, but by and large, most Americans have been very understanding, complying with the rules, trying to do the right thing in order to keep people safe. Then if we go and reopen and people start to feel something like normal and there is a return of the virus in the fall, I think that will become anger, and a lot more resentment over it returning and who's to blame for it. And it'll be in the heat of an election campaign. And by then, I think a phase 4 spending bill is going to come. Hopefully we'll have the states in a better situation. But in the same way with households, same way with businesses, state and city governments are going to be exactly in the same place. Is that whatever contribution there is, whatever help there is that's coming, it will be good. it just won't be good enough to present some reduction in economic activity from what we had before. That's a fact. Like, I don't know if the number, I don't know if it's going to be 10% below or 20% below, but it's going to be less than what it was. We're never going to fill that hole more than what was needed or what would otherwise have happened if we didn't have this crisis. So, so look, the fall could be different. We'll caveat this from now until then, but I'm just saying, like, we're going to have, we're going to say second wave like 100 times between now and then. But that, to me, that is the great big unknown. Why don't we take a quick break, come back, talk a little bit about what's happening in the EU, and then head off into the weekend. You're listening to the Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, back on the Macrocast. Some interesting things happening in Europe right now. I mean, like, I still can't help feeling, John, that they're a little bit slow to it, and that's part of the things, part of the way Europe works. It's, they need the consensus of all their members, and you have the dynamics of the French and the Germans. Here, the French and the Germans are together at least. But how is this fiscal response? It's interesting, and it's and hopefully it'll have an impact to get them back going again. Markets sure seems to like it, I think, right?
Yeah, absolutely. This is, as you say, it's pretty glacial. But as we mentioned last time, the Franco-German plan that was initially floated was 500 billion euros. That's not huge in the context of these massive pandemic relief stimulus bills we've seen here and other places. But it featured a very interesting facet, which was increased fiscal federalism. It was basically raising money for this pandemic relief fund that was going to be part of the budget with the typical contributions of all the 27 members, but the spending was going to be going to the places where it's needed most. That's the Southern Europe. And when they unveiled the plan at the European Summit on Wednesday, it was even bigger. It was based on the Franco-German plan, but it was 750 billion. And it delineated some of the much larger sized outlays to places like Spain and Italy that really needed it the most. That's really important, and it's a binding agent for the eurozone, and we've seen it in the euro. The euro is at really pivotal levels, hanging on by its fingernails, multi-year lows, and it's bounced up. It's up nearly 3% versus the dollar over the past 2 weeks. That's really important. And we've seen, Italian yields on Italian debt narrow compared to their German Bund counterparts by like 52 basis points. It's a meaningful move. And so it's not a done deal. The frugal four, as they, there are others, but, Austria, Denmark, Sweden, and the Netherlands have already begun this is unacceptable, but this is, it's going to, they're probably going to
take some muscle,
something.
but it will, it'll probably happen in some
But
form.
It's interesting because usually when you print more debt, your currency weakens. But when the market was pricing in the breakup of the EU, printing debt is something that's going to hold it together. So thus it's positive.
It's really incredible.
Yeah, it was strong move in the euro.
Yeah,
big.
Yeah, big.
Fascinating.
Yeah. So we talked about some of the data this week. What anything? I mean, we've got another couple million, 2 million initial filers for initial weekly claims data yesterday. Another 2 million people filing for unemployment insurance.
Yep. And probably the most interesting
savings
in that was the continuing claims actually decreased by a couple million. Where, I mean, it could be, part of it is definitely a counting issue with Florida and California. California doesn't have 2 week, and Florida is having a hard time with their unemployment. But I definitely think part of it was indication of the reopening of the economy, and some people actually are going back to work. So those will be very interesting to follow on a week-to-week basis, not just the initial claims, but also the continuing claims, telling a tale of two stories. This week or next week, we'll find out the official BLS unemployment and non-farm payroll for May. So we lost 20.5 million jobs last year, and we got up to 14.7% on the unemployment rate. Looks like expectations are for another 8 million jobs lost, and the unemployment going up to 19.5%. So that's the big event for next week. We also have a ECB, a Bank of Canada, and the Royal Bank of Australia meeting. So, but so many of the central banks have already shot the cannons. So I think this is more of a, keeping things as they are and maybe tweaking things here and there.
Yeah, well, we'll definitely be interested to see where the rate goes on U.S. payrolls. So I mean, 19.5 is expectations. I'll be surprised actually if it isn't over 20%. I think 40 million filers is
I think so too, because I think you probably still get large revisions to the previous 2 months that will kind of drive it up. So I would expect it to be over 20%.
Yeah, I think that's right. Well, we'll see. It'll be a big jobs day. In the meantime, we have the Twitter wars to pay attention to. Trump signing an executive order yesterday, doing something,
Well, some of the commentary I've heard is the ultimate irony of this whole thing is he might have actually tied his own hands the most with his own ruling.
If it had the impact of actually effectuating anything,
yes, exactly.
I mean, they're governed by they're governed by statute. You can't change it by executive order. But yeah, the logical conclusion for someone who, shares and initiates a lot of things on Twitter that are untrue, to say that Twitter would be liable if it allows people to post things are untrue. Seems to be shooting yourself in the foot. So, yeah. So, and which
that's coming from a communications expert. That's communications 101.
Exactly. So we'll see how that plays out. One of the great things on things like this is that in the world of social media that we're in right now is that we get to see all this happening, live and in person. So we'll get to follow along on Twitter. But in the meantime, thanks guys. Great show. Good stuff to talk about. We'll be back for Jobs Day next Friday. Matt McDonald will be with us, and lots more to talk about. Have a great weekend and stay safe.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.